Okay, what if I told you that a super simple, literally set it and forget it strategy consistently crushes Wall Street's top stock pickers? Welcome to this explainer. Today we are setting up a massive $10,000 financial showdown. We're going to take exactly $10,000 and put it to the ultimate test to see how it behaves under two radically different investing philosophies. So here is the burning question. Given the exact same starting cash and the exact same timeline, who actually walks away richer? It's like a heavyweight boxing match. In the left corner, we've got the index fund investor, and in the right corner, the individual stock picker. They start with the exact same capital, but they take completely different paths. So who's going to come out on top?
All right, let's kick things off with round one, owning the entire market.
So instead of frantic, stressful trading, an index fund automatically buys tiny pieces of hundreds of powerhouse companies all at once. With just one single purchase, you instantly own a slice of Apple, Microsoft, Amazon, Google, and Nvidia. You never have to guess the winner, because you just own the entire market. It's the whole shebang.
But on the flip side, you have the stock pickers. These guys try to beat the market through intense, grueling research. They're grinding through charts, reading earnings reports, basically trying to predict the future. And hey, sometimes they win big, but sometimes they lose really badly.
Moving right along to round two, the real numbers revealed.
Let's strip away all the hype for a second and look at the math. If both of these investors contribute $500 a month for 20 years, an index fund tracking the S&P 500 has historically grown at a super reliable 10% annual rate. But the stock picker, man, it is highly variable. You might strike gold, sure, or you might barely break even.
But wait, just when things look good for the stock picker, what happens next? Seriously, what happens when a stock you've poured your life savings into suddenly crashes?
That brings us to round three, the hidden risks of stocks. Let's trace the timeline here. Year one looks amazing, right? Giants like Tesla, Meta, or Netflix are absolutely soaring. But by year five, a bad year hits hard, erasing those gains in a matter of days. By year 10, a seemingly invincible company can totally collapse under pressure. And by year 15, it completely disappears into a cemetery of failed companies forever. Poof, gone.
And right here is the massive difference in risk. Index funds are kind of magical because they're self-cleansing. They automatically flush out the losing companies and replace them with new winners. But stock pickers, you have absolutely zero built-in safety net. If you pick wrong, your money is entirely exposed.
Now here's the surprising part that most investors never realize. People get so hyper-focused on picking the next big winner that they completely forget the devastating mathematical penalty of picking a loser.
Let's look at the pros in round four. Why Wall Street professionals fail. Want to know the shocking truth? Most full-time Wall Street fund managers, we're talking people with massive teams, supercomputers, and crazy insider access, actually fail to beat a simple, boring index fund. Year after year, the vast majority earn a massive red fail.
Really think about that for a second. If full-time professionals, whose entire careers depend on getting this right, are consistently failing, what chance do we have picking stocks in our spare time on a weekend?
Okay, let's be totally fair and jump to round five, when individual stocks actually make sense. Individual stocks absolutely can create huge wealth, but only if you follow some incredibly strict rules. You have to spend years intensely learning the market. You must actively research like a Warren Buffett-style investor. And maybe most importantly, you have to accept a significantly higher risk of losing it all. It's a massive, massive commitment. It is definitely not a casual hobby.
Which brings us to the final verdict.
So here is the reality, plain and simple. For the vast majority of us, index funds win, hands down. They require less time, cause way less stress, and offer significantly better statistical odds of building long-term wealth. Stock picking? It's high stress, a massive time commitment, and the mathematical odds are just terrible. Because at the end of the day, getting rich isn't about finding the next big stock. It's about staying invested long enough. Consistency and compound interest easily, and I mean easily, beat the chaotic stress of stock picking.
Thank you so much for joining this explainer. I want to leave you with this one final question. Are you going to keep gambling your hard-earned money trying to outsmart Wall Street? Or are you ready to just own the entire market and let the math do the heavy lifting? Subscribe to Wealth Decode to master the market, and I'll catch you next time.